You know how the banks always say that a 15-year mortgage is better than a 30-year mortgage? Well, let's take a look at it from a numerical standpoint using the Truth Concepts suite of calculators. And let's take a story approach to it first. So when you think about this situation, I know for myself, I look at the discipline that it takes to have a 15-year mortgage payment. It's a lot more money. And in our heads, we think, oh my gosh, it's going to save interest. So this is a good thing. Yet all of life has trade-offs. And so it's important that we understand the trade-off when we approach our mortgage with that environment. So think about an ice cream sundae. I would like you to have the kind that has the ice cream with some sauce on top, with some nuts on top of that. You can have the cherry or not. I'm not a big fan of them, but it's multiple, right? Has a whole bunch of stuff. I don't want you to just have the single kind where you're stuck. And this is really the deal with the 15-year versus 30-year mortgage discussion is the 15-year mortgage, you're stuck. You have a single kind of ice cream. The 30-year, you have this amazing ice cream sundae. And the practical application of this is that with a 30-year mortgage, it creates more opportunity for you. So let's take a look at this mindset. And again, I applaud you if you feel like you have that extra discipline. That's amazing. And yet it's costing you opportunity. So we're going to look at the loan analysis calculator from, again, the Truth Concepts suite of calculators. And we are going to enter a loan balance of $400,000. So this is a brand new home, $500,000 home. You put $100K down. And we're going to actually choose a loan rate that is not maybe perfectly accurate for today, but more accurate and reflective of life over time. So I'll just use a 5.5% on the loan rate. And then the longest number of period is going to be our 360 months. And then the loan 2 is going to be the 180 months, the 15-year mortgage. And so as we progress through this thinking, one of the first pieces that comes up is the information from the banks that this 30-year mortgage has more interest. So you can see here, that is a true fact. However, it is just a fun fact. 817,000 versus the 588,000 on these two deals. Now, we also want to take a look at the cost of cash. What if we had $400,000 that we could pull from a savings account rates? Now, for illustration purposes, I'm going to use the same 5.5%. Well, if we did that, that would actually have cost us $2 million because it is being pulled from an account that is earning an interest rate. Now, I'm using the same interest rates across the board here on purpose so that we don't get confused, because in a scientific analysis, you can only change one variable at a time. And that variable right now is that 360 months versus 180 month, or 30-year mortgage versus the 15-year mortgage. So as we progress further down this path and we take a look at the various pieces, I want to prove to you this 400,000 at 5.5% over 360 months is $2 million. And then I also want to prove to you that a very interesting fact is occurring, and that is that the 360 month payment, this $2,271 at the same 5.5% over 360 years, is the same $2,074,074. And this took me over 3 years to understand when I was new in the business. And I had told my parents to get a 15-year mortgage and make extra principal payments on it. So I had a lot of baggage to let go of before I fully understand this. So this is a video. Start it over, play it back, work this through. If you're curious about it, I've got it all written out in my book, Busting the Interest Rate Lies. But let's go on and continue to take a look at this. So the next piece that comes up is, well, what about the fact that if I was making the 15-year payment over 180 months, the 15 years at the same 5.5%, I could then save my payment starting the 16th year. Well, let's take a look at that. If I did save that payment, so take the money that we had to begin with over the next 180 months at the 5.5%, it's the same $2 million. And I think this is a real stretch for our thinking. So let's keep digging in here. Now we can see the same 2 million when opportunity cost is applied in all cases. And opportunity cost must be applied because dollars exist in time, and it's the biggest challenge around personal finances. We have to add time value of money to all of our equations. Otherwise, we're not doing them accurately. So as we progress here, we want to add in the income tax bracket. So let's just pick 24 for now, because we do get a deduction for the interest that we're paying on the mortgage. And so that has a bit of an impact. And then we want to take a look at that impact. So here's the value of the savings that we get on the 30-year mortgage versus the smaller value of savings that we get on the 15-year mortgage, thereby making the net 15-year mortgage cost more than the net 30-year loan. And then we can also take a look at what inflation does to those dollars, because if we apply just a 3% inflation rate, that same $2,271 payment, while we would write a check for that, it would feel like only $924. And isn't it wonderful? There are two things that benefit from inflation. One is whole life premiums that stay level and are guaranteed to do so. And the other is a 30-year fixed mortgage payment. So I hope that information has been valuable to you. And I really want you to be able to create more opportunity for yourself as you're going forward in life, and having a 30-year mortgage where you are taking into consideration all of the costs, all of the gains, the proper time frames, is going to give you more opportunity to do other things and have more certainty in your life than a 15-year mortgage. Enjoy the mental challenge.